Welcome to the March 2026 investment strategy. I'm Vishal.
And I'm Sharvari. Vishal, this month really split the market. Energy and PSU banks moved sharply higher. IT corrected meaningfully, and India and the US signed a landmark trade agreement. Quite a lot to unpack.
Absolutely. And the big question every investor is asking, are we finally entering what many are calling a Goldilocks phase with strong growth and balanced inflation?
Let's break down the data and see if it holds up. So let's start with performance. The Nifty Next 50 was the outperformer this month, gaining 6.38%. Small caps gained 4.79%, mid cap 4.68%, and the Nifty 50, it trailed the pack at just 1.78%.
Right, Sharvari, and that tells you something important. The broader market is doing the heavy lifting right now. When mid caps and small caps outperform large caps by this margin, it signals money is rotating into growth-oriented, domestically linked stories rather than the globally exposed heavyweights.
Exactly. And speaking of heavyweights, let's talk sectors. Energy topped the charts at 12.5%, PSU banks followed at 11.5%, and consumer durables, metals, defense, infrastructure all ranged between 7 and 10%. But then there's IT, down a staggering 20.1%.
That IT number is brutal. The Nifty IT index has now declined 17% over 3 months and 22% over 1 year. The AI disruption narrative has created panic. But here's the nuance that investors should note. Infosys recently disclosed that 90% of its top 200 clients already use its AI services. There have been no contract cancellations, no revenue guidance cuts, no earnings misses.
So, you're saying the sell-off might be overdone, Vishal?
Near-term volatility may persist, absolutely. But medium-term earnings and long-term competitive differentiation will ultimately decide winners and losers. Don't write off Indian IT just yet.
Fair point. Now, let's talk flows. After 7 months of relentless selling, FIIs finally turned net positive in February, buying rupees 896 crore. It's nominal but directionally important. DIIs continued strong with rupees 26,130 crore of inflows.
And on valuations, the Nifty 50 forward PE has come down from 20.9 in January to 20.4 by mid-February, which is now very close to its 3-year average of 20.3. That's significant. After months of being expensive, we are back in the comfort zone.
Shifting to the global picture, US Q4 GDP came in at 1.4% annualized, below expectations. Full year 2025 growth was 2.2%, down from 2.8% in 2024. And the PCE index, the Fed's preferred inflation gauge, accelerated to 2.9%.
And that's the Fed's dilemma in a nutshell, Sharvari. Growth slowing, but inflation firm. Markets are now recalibrating rate cut expectations for 2026 because sticky inflation and strong labor data are keeping the Fed cautious. The higher for longer narrative continues, and that's weighing on tech valuations globally, right?
Couldn't agree more. Meanwhile, there's the big India story. The India-US interim trade agreement, tariffs on India exports slashed from 50% to 18% as per the announcement. That makes India one of the most competitive Asian exporters to US market.
And it goes both ways. India is cutting tariffs on US industrial and agricultural goods and has committed to purchasing $500 billion worth of US energy, technology aircraft, and metals over 5 years. Though, one important caveat, the agreement hasn't been formally signed yet following the US Supreme Court's ruling on earlier tariff measures.
And what about the rupee, Vishal?
It saw some volatility through February. The rupee depreciated 0.7% during February closing at rupees 90.9 per dollar. It actually touched a record low near rupees 92 in late January due to the FII outflows and a stronger dollar. But sentiment has improved and it's recovered since. With forex reserves near record highs, external stability remains intact.
Moving to the fixed income, the RBI unanimously maintained the repo rate at 5.25% and kept the stance at neutral.
No surprises there, Sharvari. But what's interesting is the revised inflation outlook. The RBI raised its Q1 FY27 and Q2 FY27 inflation projections to 4% and 4.2% respectively. CPI for the full year FY26 is projected at just 2.1%, and under the new CPI series, January retail inflation came in at 2.75%.
Tell us about the new CPI series. That's a structural change, right?
Absolutely. The revised CPI reduces foods weight to below 40% for the first time and raises non-food categories to over 60%. It also includes 350 plus items. What this means practically is that inflation readings will be less volatile and less sensitive to short-term food price spikes, giving us a clearer picture of underlying trends in services and discretionary consumption.
And on growth, the MPC revised GDP projections upward. Q1 and Q2 FY27 now at 6.9% and 7% respectively.
Manufacturing grew 8.1%, electricity rebounded to 6.3% from a contraction. Bond yields like the 10-year benchmark GSEC rose marginally by 3 basis points to 6.68%. Short-term yields have eased faster thanks to RBI's liquidity operations like OMO purchases. The call rate dropped sharply from 5.39% to 5.08%.
So, Vishal, putting it all together, where's the strategy call here?
India's macro backdrop is amongst the strongest globally. Benign inflation, stable fiscal metrics, healthy liquidity, and now trade agreements with the US and EU adding medium-term tailwinds. The government has even allocated dedicated funding for AI infrastructure and data centers in the budget. We are entering what could be called a Goldilocks phase.
That's interesting. An equity strategy?
Valuations have corrected to healthier levels. The strategy is clear. Alongside large caps, investors should allocate to mid caps and select small caps in a staggered manner. Increase overall equity allocation and add precious metals like gold and silver as a strategic hedge, not as return generating assets.
What about debt?
Since we are nearing the end of the rate cut trajectory, the smart move is to focus on accrual strategies and the short end of the yield curve. Gold and silver allocation here too makes sense, driven by central bank demand, industrial use, and geopolitical uncertainty.
And the risks to watch, Vishal?
Two main ones: ongoing ambiguity around US tariff policy and persistently high crude oil prices. Both could add inflationary pressures and dampen market confidence. Stay alert, stay diversified.
Let's get practical, Vishal. How do you structure your portfolio? We have model portfolios for different investor types, and this really helps putting things into perspective.
Absolutely. Let's walk through each one.
First, the aggressive portfolio for investors who can handle higher risk and stay calm during volatility. If you want maximum long-term returns and can ride out the swings, this is for you.
Next, the moderate portfolio for investors, comfortable with average risk, looking for returns better than fixed deposits, even if short-term performances dips at times.
Then, we have the conservative portfolio, ideal for risk-averse investors who prefer stability and capital protection over aggressive growth.
Now, the regular income basket for investors with a lump sum who want steady cash flows from their investments.
And for those bullish on India's growth and willing to take concentrated bets, there's the Build India basket, a high conviction, high risk option. All right, let's wrap it up with 3 takeaways. 1. Broader markets are outperforming and valuations have returned to their 3-year average. 2. The India-US trade deal and RBI supportive stance are strong medium-term positives. And 3. Stagger your investment across large, mid, and small caps, and don't forget gold as a hedge.
Perfectly summed up, Sharvari. And as always, a quick reminder. Everything we discussed today is based on the Mirae Asset Sharekhan March 2026 Investment Strategy Report.
If you found this useful, hit that like button, subscribe, and drop your questions in the comments. See you next month.
Happy investing, everyone.
Mutual fund investments are subject to market risk. Read all scheme and related documents carefully before investing.